Amit Kukreja, CFP and founder, Wellspring Advisors, with us here on this segment, of course, also to take all your tax questions. Amit, thanks very much. So,
Pleasure.
I mean, you've returned from abroad. What's going on? Are big guys in the US really looking at this crash in the rupee as a great opportunity to invest in India's real estate?
No, I don't think they're looking at it as a crash. I think they are being extra cautious because if they are seeing the trend of currency depreciation against US dollar, and if that depreciation continues, it's going to be difficult for them to make money out of it if they want to take the money back to US or to any other country outside India for that matter. Second, we have to look at the limitations. In any given financial year, NRIs can take back no more than $1 million out of India. So if the guy is churning properties or any other asset which is producing more than $1 million for his investment term, he will have to take RBI clearances and all that stuff. So they are cautious about the macroeconomic factors, they are cautious about the RBI guidelines, they are also cautious about the political stability and the governance factors. So people are in a wait and watch mode until the elections happen, and they are not going to do investments until there is the rupee appreciation trend started to being witnessed, and until government has taken very strong radical steps to encourage foreign institutional investors investing money in multiple markets, not necessarily real estate.
So you're saying that they need to see a reversal of trends. Number one,
Absolutely.
even before they will consider, and number two, what happens if rupee continues to depreciate? When they actually pull out the money, they're going to be losers and even lose the gains that they make on that capital investment right now.
Correct.
So perhaps only end users, people who want to come back, for them this 18%, 20% correction which has come to them or handed over to them simply because of the currency devaluation, is it a good time for them?
So people who people who love to maintain a portfolio based in India, it might be an opportunity for them. People who want to have a retirement portfolio built up 5-10 years down the line, and they are very sure that the money will not be taken out of India, it's very good opportunity for them because they may get the property possession taken, they may start leasing it out or renting it out and start building rental income so that their reliance on their jobs goes away by the time they are retiring. So very long term, people who want to have something very solid established, giving them periodic returns on a monthly, quarterly basis, it might be an opportunity for them. But again, not everybody is so much keen on buying something now for something which is 15 years down the line. So not a heavy percentage of their portfolio goes there.
All right, so there goes the hype. Front headlines of all the pink papers, NRI money pouring into India's real estate.
I would tend to disagree.
Disagree?
Right?
Okay, let's hear that out.
See, my view is that if you look at the Indian real estate from 2009 to 2013, it has witnessed phenomenal real estate returns. And if you look at the global real estate markets, they have depreciated. So even if your currency did appreciate, your real estate value actually dipped, whereas over here, the property prices went up from 30% to 70-80%. Even now, if an investor is looking
to make... you yourself are saying that going forward, you're not going to have the same party as last 3 years.
But what I'm talking about is we're looking at a 5-year view. So first of all, the rupee has depreciated. You're buying at probably a time where you can negotiate much better. There are hardly any sales happening in the market, but that's the right time to actually look at buying if you feel that the markets will recover, which I think they will recover over the next 5-year period. They will give you that 20% return. So even if the rupee depreciates by 5 to 7% year on year, globally you're not making 10 to 15% on real estate assets.
Okay. All right, so 5 years is what Amit also said. If you have a long-term horizon, then this is a great time to buy. But you can't just come in and try and flip money or see this as a short-term opportunity. That's how it's presented. That, oh my God, rupee is crashing, and guess what? Money is going to flow in from NRIs into India's real estate. It doesn't happen that quick and that automatically. Meanwhile, let's also get on with our tax questions. Nikhil Jain on the phone line with us. Hi, Nikhil, go ahead.
Hey, hi.
Hi.
Hey, I have a question related to the capital gain.
Yeah.
So as I understand, the tax laws say that the gain from a sale of a property is considered as a capital gain if it has been under construction for more than 3 years or it has been under possession for more than 3 years. Right. So I want to understand what is meant by possession here. So is it the registration or the NOC from the builder?
Oh, simple enough. What does it do?
Yeah. So, Nikhil, you have to remember there is two-phase situation. When the property is in the under construction stage, it's not a residential unit. It's a right to acquire a residential unit. It's a capital asset, but it's a right to acquire. So if the under construction phase has gone beyond 3 years, you can sell that right to somebody else and make your long-term capital gains and exempt it from taxes. Once you have taken the possession, it becomes from the right of capital asset, from the state of being a right to acquire a property, it becomes a residential unit, and and the change of nature of that capital asset makes it a situation where you will have to hold it for 3 years from the date of possession to make sure the long-term capital gains are there. In your situation, possession is an important point. Before taking possession, if you want to sell it before taking possession, because it has already taken more than 3 years. The gains that you make will still qualify for a long-term capital gain. But if you take a possession and you want to avail a long-term capital gain situation, you will have to hold it for 3 years. Otherwise, you can sell it even after taking possession, but it will be a short-term capital gain.
So it's after possession you got to hold it for 3 years.
That's correct. See, possession changes the status.
Under construction for 3 years is not what can be counted.
No, that's also a long-term capital gain. But the nature of capital asset is different. When it's under construction, it is right to acquire a property. The unit is not ready. But when you have taken the possession, it's a capital asset, but it has become a residential unit. So in this case, if he hadn't taken possession, he would have been better off, because anyway it was under construction and he would have been able to, and sold it before taking possession, he would have been able to avail long-term capital gains, Amit? That's correct.
Good Lord, I didn't know about this.
I didn't know that. Nobody knows that. In fact, are you saying that then if you reinvest those proceeds in another property, will you be able to offset that?
So there are differences. When you sell the right to acquire a property, which is when you sell your right during the under construction phase, beyond 3 years, you will have to reinvest the entire sale proceeds, because that qualifies,
not just the capital
not
gain
just the capital gain, because that falls under section 54F. But once the unit has become possession ready and you have taken possession, you will have to reinvest only the capital gains, because it's a section 54.
Oh my God, that's a very interesting nuance, and of course a very important one for all of us to know, because if it's an investment, we really don't know, not very clear in terms of when we should be selling it to get our property sale considered for long-term capital gains. Alright, let's move on. There's another question from Aditya. He says, I've booked a flat in Gaur City 2 in Noida Extension. As per the wording of the allotment letter which I've received, group housing project, it says that the basic cost is about 49 lakh rupees plus service tax as assessed and attributed by the Government of India, payable as per the payment plan. The lettering says if you apply service tax of 3.5%, then the total cost will cross 50 lakhs. But this calculation is not mentioned in the allotment letter. As per the above case, is TDS applicable on the basic cost, or do I need to add service tax in basic cost and then pay TDS? Amit, again, very interesting nuance. Everybody is facing these problems. So what do you calculate your TDS, that 1% TDS on?
So TDS is to be calculated on the money that you are paying in consideration for the property. So anything that you have paid to the builder includes basic cost, EDC, IDC, anything which has gone in favor of the builder, that amount gets added up. If that exceeds 50 lakhs, you are free and you should be deducting 1% of the TDS in the name of the builder and giving him the certificate. However, if the total amount is less than 50 lakhs, then TDS is not required to be done.
But what does he do with the service tax? So his question is, I am below 50 lakhs if I don't add the service tax, but if I add the service tax, I cross 50 lakhs. So then am I liable to withhold TDS?
Service tax will not be included.
It can't be included. You can't be taxing on tax.
Correct.
You can't be taxing on tax.
But I think his thing was its basic cost of approximately 49 lakhs.
It's not basic. It's all other charges. Okay. All right. So everything that you pay for, you've got to look at it not at the basic price of the flat. If that crosses 50 lakhs, you definitely have to withhold TDS and account for it. If at all service tax is charged, you can't charge a tax on a tax, so that won't be considered. Okay, we also have some more points that we have you in the studio after a long time to discuss rentals. Now, you know, a huge amount of property price or high amount of escalation in property prices are forcing a lot of Mumbaikars especially to consider renting out option rather than buying out outrightly. And in most cases, to what extent is HRA actually excluded from being taxed, Amit?
Yeah. So using HRA, you can save more money than staying in a self-occupied property. So there is a simple rule which is called Rule TA in 2A in the income tax books, that if you are availing HRA, there is a portion of HRA that gets exempted. You'll have to apply a simple rule. 1, look at the amount and choose the least of the following: A, the HRA that you receive; B, the rent that you pay; and C, look at the amount that you are paying in excess of 10% of the basic salary that you are paying. So whatever comes out to be the least of the 3, that gets exempted from tax, and the balance is taxable. But it's a misconception that the entire HRA is exempted from tax. It is not. Actually, only a portion of it is exempted from tax, but the calculation needs to be done for that one.
All right, well, that's a lot of tax issues cleared up. Amit, thank you very much for being with us here on this show and this expert segment.